Okie dokie. I make it 1 minute past. What do you think, Rhoda? Should we kick off?
Yeah, okay.
Perfect. So first of all, a bit of housekeeping. Just a heads up. This meeting is, or this webinar is being recorded, and a recording will be available after. If you have any questions, please feel free to drop them in the chat, either to everybody or to us individually, and we'll kind of answer as we go along. There is a Q&A section at the end, but no harm in making a whole load of questions ready for us to answer at the end. And there's a QR code, of course, several QR codes. One that covers the possibility of having a meeting with myself. So feel free to follow that, and you'll get a link to kind of the ability to book a meeting. And secondly, at the end, the PE white paper that we've produced, which is the subject of this presentation today. So without further ado, let's kick off. Brody, would you like to say hello?
Yeah, of course. Look, hello everyone. Thanks so many of you for joining. To introduce myself briefly, I'm Rory Thomas. I'm a director at the firm, particularly our cyber risk team, and especially working with private markets investors on all things cyber risk. So delighted to be talking with you all today. Delighted to be with you, Ed.
Wonderful. Thank you very much. And yeah, Ed Starkey. I work alongside Brody in the cyber risk team here at Thomas Murray, spending a lot of time with PE, supporting them in their objectives. Cool. So a little bit about Thomas Murray first. Rowley, I think if I hand over to you for the introduction.
Yeah, of course. Look, for those of you who don't know Thomas Murray, it's quite a well-kept secret in the industry. We have a 30-year heritage, so we've worked with many of the, I think you'll see a slide in a sec on some of the logos, but a lot of blue chip banks, particularly on the custody side, a lot of institutional investors, a lot of LPs. That's our sort of DNA as a firm, looking at operational risk in the investment industry. About 5 years ago, most recently, we launched a cybersecurity business, specializing again in our core DNA, so specializing in the investment industry. You've got a handful of logos we're allowed to display here. We work really extensively in private markets, both with private equity firms, credit firms, other kind of alt investors, and then increasingly with LPs on their ODD as well. So we sort of see the industry from a few different lenses, but that's the sort of premise from which we're talking to you all today.
Wonderful. Thank you so much. And I think it's really important to have that background, because I think it gives us a degree of credibility when we're talking about kind of what we're seeing in the space. It's both the top down and the bottom up kind of pressures that we're able to kind of competently talk about, which kind of leads us very nicely into I guess what's going on at the moment, I guess, why this existing environment is a challenge for organizations, and why the paper that we've produced we think is able to kind of offer such value. So there's a shift in kind of how private equity and industry generally is being forced to behave. So in terms of what's kind of listed there, we've got kind of high rates, lower exits, and of course the greater kind of scrutiny, particularly around the operational complexity that I know, Brody, you wanted to talk about.
Yeah, absolutely. I mean, so look, I mean, just it's quite hard to differentiate the kind of current noise versus the overall trend. So, I mean, if you're reading the FT this morning, you're looking at, outflows in private credit, 10 billion outflows in the last quarter, Blackstone, Blue Owl under scrutiny, and, slightly panicked voices talking about 2008. And then some, probably more moderate voices saying, well, actually, no, look, you've not got the same leakage from private markets into the wider financial sector. You've got closed-ended funds. And actually, what all you're seeing is a very slight readjustment with 5 billion in inflows into private credit, for example, in the last 5 years. This is a very small adjustment you've seen in the last quarter. And so sort of we almost, in the context of this paper, we're sort of trying to ignore some of that noise and circumstance at the moment and just focus on wider trends. So huge growth in private credit in the last few years. Difficult year last year for private equity, but actually, when we talk to our clients, they're pretty bullish. They're raising money, they're cracking on with acquisitions, and so paying much more attention to operations and operational risk. I think on the private equity side, some of the challenges in the last year, it's obviously a sort of higher borrowing cost environment, difficulty around exits, but there's a real focus on operational complexities, operational risk. That's our focus really as Thomas Murray. That's our expertise, particularly on cybersecurity side. Yeah, Ed, and anything else you'll say here?
No, I think you've covered it really nicely. The only other bit that I would add is that, as you said, the optimism that exists within the market really it's a proven strategy for value creation. So it's almost an adjustment to the rules rather than a completely new game. And I think the cybersecurity bit that we'd come into kind of shortly is exactly one of the areas where the rules have changed subtly, and more is expected of private equity. But ultimately, yeah, it's a positive. Generally, it's positive feeling, and I wouldn't say it's consensus, but it's largely positive.
Yeah, and ultimately, I mean, just before we move over, and this very brief presentation. So I didn't say at the start we're going to talk for no more than 20 minutes. We were acutely aware of your time, and then we'll take a couple of questions at the end. This paper really is about how cyber strategy can add value and can protect value for private markets investors. That is the scope of what we talk to our clients about day in, day out. That's the focus of this paper as well.
Wonderful. Thank you so much for making that point. As you said, should have mentioned that at the beginning, but we will respect your time as much as possible, whilst making sure that we give as much value as possible as well. So, absolutely. So, kind of moving on a little bit. So, I guess what we've seen and I guess what we are seeing and what we have seen is that cybersecurity is just becoming increasingly important within the investment lifecycle, within the window of ownership of organizations. The whole piece around kind of value creation and value protection is inextricably linked with cybersecurity now. We've got the 1 to 5 on the slide here, but an event, operational disruption, EBITDA impact, financial pressures, and ultimately the exit side of things. And for each of these, we've got examples of organizations and ultimately kind of transactions and investments where we've seen exactly that. We've seen the EBITDA impact, the financing pressures with the covenants tightening, which we've got a slide about that coming up. And ultimately the exit discount. It's I think 2025, as we saw, kind of brought that into sharp focus, particularly with some of the broader cyber incidents that occurred with kind of JLR, M&S, and the co-op, where we saw significant kind of financial impact. So the link between cyber and EBITDA has been strengthened by as a result of those incidents. Brody, anything else to add?
No, totally. Look, and I think the really important context of this slide, and actually of the paper in general, is that so often when we are speaking to our clients, and it's the CIO, CISO, CTO, head of IT within the fund, they are getting sort of more and more questions in kind of ODD coming from LPs around cybersecurity. That's being flung at them, at you, I should say, and with responsibility to answer that. And to address the gaps you're seeing in that, to address the gaps that you as experts are seeing in your businesses, you know what investment's required. But sometimes very often what we are helping clients with is to articulate the business case for cybersecurity. And that's what this is. So you get, cyber event for most investment professionals is a fairly abstract concept, or at least it has been until recent years. Numbers 2 through 5 here are really about the financial implication, the business implication, the investment implication of a cyber event. So, operational disruption, as you know, is inevitable in most cyber incidents. And then immediately there's a focus on the wrong side of the balance sheet, looking at operational losses, partially covered by insurance. I think, Ed, you might have mentioned M&S. You saw, I think it was 100 million of insurance coverage against 300 million pound losses. Putting things as starkly as that is a really simple way that we often articulate the business case for an investment committee, for a management committee of a private equity business, for example. And then as you get through, we'll talk about covenants in a private credit context, actually in a private equity context as well, in a moment, because we cover private credit quite extensively in this paper. But coming on to the sort of exit discount, it's not really just about exit discounts. I mean, we were speaking with an operating partner recently who was saying that, obviously cybersecurity is something they look at in an acquisition. It's one of the due diligence streams. He was saying that the best case scenario for him as a kind of middle market private equity firm is when a target company opens up the books and is very honest about the cybersecurity issues that they have and what they are doing to address it. And this, Ed, as a sort of cyber M&A lead at Thomas Murray's, you're all over this. But where he is spooked is where a target acquisition either doesn't know, the relevant person he's interviewing does not know the cybersecurity posture of the business, or they're clearly trying to cover things up and put them under the carpet. Those are the red flags, and actually transparency around cyber issues and a roadmap to remediate them is what they look for. And I mean, Ed, I don't know, got a comment on the exit discount piece where we've seen some delays, money being taken off the table, or actually termination of transactions as well.
Yeah, so a number of kind of instances where this has happened, and I've been involved in transactions, and the last thing I'm conscious that the last thing you want to do is kind of essentially kill the deal. But a couple of times where a breach has been identified, or just the lack of alignment between the existing controls and environment and the value proposition of the business. So where cybersecurity is central to supporting and protecting the that kind of value proposition, the investment thesis, but there's no underpinning controls, and there's a risk of it, the IP, IP is lost, reputational damage, all that kind of good stuff. It's something that we do see. I guess it's an uncomfortable truth, isn't it, really? The other thing that's also worth considering and kind of highlighting is that with breaches, we've got a slide about some of the incidents that we saw during 2025 coming up. An incident isn't one and done. Yes, the immediate disruption kind of has in an ideal world has a very kind of definite end, but the long tail impact of incidents can go on for years. So whether it's claims, whether it's kind of credit monitoring, that typically you'll put in place for kind of 2 years. Often there is a nasty smell that's associated with the business after a cybersecurity incident, and that's often flagged during the DD, or ideally. It's worth actually saying on the DD itself that we've also heard quite recently that IT due diligence does not equal, or does not amount to the same as a dedicated kind of cyber due diligence effort, and that some nasty surprises have been identified as a result of kind of ineffective cyber DD. So that's something that we can talk about shortly. Wonderful. Should we jump on to the next one, really?
Yeah.
Perfect. So yeah, just a little bit more about kind of the environment within the environment that we're kind of operating in at the moment. As we said, the game hasn't changed. It's just the rules have adjusted kind of slightly. So it's just more, I guess it's trickier, it's more difficult. There's a greater focus on detail, the level of awareness and understanding of cybersecurity technology, and ultimately that supply chain discipline kind of has increased across the board, and there's a greater kind of focus on it. On the left hand side there, the holding period for funds has grown, so there's more opportunity for PE to really engage with their portcos and ensure that the foundations of a successful business are kind of put in place, and it's expected, with cybersecurity absolutely being one of those kind of core components. Roby, anything else to add?
Yeah, it's worth saying. I mean, look, the received wisdom until very recently, I remember an investment banker saying to me probably 5 years ago that any private equity firm telling a potential portfolio company or potential acquisition that, we are different, we'll add value to your business, we'll invest time, not only money, in your business and expertise, and you'll benefit from services from across the portfolio. All of that was regarded as nonsense, broadly speaking, until very recently, I'd say. And you would always caution, or bankers would always caution private companies to be very wary of private equity firms saying that they can add value to the firm that the firm wasn't already bringing to the table beyond the investment itself. That has changed, and I think it's not window dressing. We are now seeing, because of the more difficult operating environment, because of all the stuff we covered at the start, you are seeing more value creation teams emerging. We're seeing value creation teams subsuming sort of operational risks, subsuming IT and cybersecurity as a function, so that you're all enrolling in the same direction, trying to add value to the portfolio and scrutinize risks in the portfolio which could be value destructive. And I think with that, so we are engaged, where we used to engage with heads of IT and they would be kind of in isolation within the firm. We are now, we're speaking to them as part of a value creation team, or we're speaking to an operating partner. And there's far more engagement in the portfolio. There's far more sort of collective buying power that they're trying to engineer. And there's sort of CTO forums and things like that, which these teams are pulling together to add real value to their portfolio, to try and provide real resilience and to try and measure kind of risk as a backstop as well. So I think that is a really tangible change from the environment we were a few years ago, where companies would be deeply skeptical about the value that a private equity firm would add to them beyond the investment. So it's on the plus side, it's a really interesting environment to have your roles, because I think a lot more IT teams, a lot more cybersecurity teams are being asked to work with portfolio companies to provide that value.
Yeah, I think it's a really, really interesting point. I think you could have outlined it really nicely there. I think it's an example, I guess, that it kind of indicates the way that technology is being considered. One PE firm that we've been talking to recently said that in their IC memos, there's an explicit requirement to outline why AI, or the adoption of AI by others, by competitors, will not undermine the value of a potential investment, which I thought was fascinating. This forward-looking element around kind of AI use by not only the investment but potential competitors, and the shift in industries that we're seeing. I think all speaks to this kind of greater kind of operational discipline and the focus on kind of fewer surprises, with the pressure, of course, of kind of needing to adopt AI and kind of new technology. So, yeah, it's absolutely fascinating from where we're sitting. And organizations, I think, particularly private equity, is sitting up and making note of this. And as you said, looking to add real value. As you said, it's no longer just kind of window dressing. It really is something that organizations are doing, and I guess portfolio companies are almost expecting.
No, it's interesting, and actually, even in the last few weeks, we've been having conversations with firms where, from an investment perspective, obviously AI is very exciting, but as you say, the investment committees are talking more and more about the risks to their portfolio, comes to the existing portfolio from AI. And we're speaking to sort of, heads of IT, ESG, cybersecurity, who are trying to get to grips with sort of AI governance internally within their firms, in their portfolio, AI security as well. And trying to very often trying to identify whose job it is to get on top of that, and actually have total clarity about that, because it can slip through the gaps very easily between a risk and compliance team, an ESG team, an IT team, an external MSP. And so one thing we're certainly working with clients on is trying to help them get that clarity, both internally and in the portfolio, in terms of kind of AI governance, AI security.
Yeah, I think we mentioned earlier on about the insights that we had with LPs. And I guess one of the key questions that's been added to the due diligence efforts by LPs is what's your position on AI? Do you have an AI policy in place, AI security policy in place? Are you do you have a program to manage that risk? Again, something that we're able to kind of comment on, and as from our perspective, find absolutely fascinating. Wonderful. So private credit, obviously, there's lots in the news at the moment. As Rody touched upon it, kind of right at the outset, regards to kind of Blue Owl in particular, making kind of headline news. But essentially, what I'm not going to go through the numbers, but essentially on the right hand side here, it's just worth kind of highlighting that there is this link between cyber security. There is a very kind of tangible cost that's now kind of understood and it is kind of increasingly kind of appreciated as having having the potential to have a very, very negative impact on organizations and their EBITDA and cash flow. So where does some of this come from? Kind of downtime, billing, production shortages, all of this kind of brought to light by the incidents that we can talk about kind of shortly. But essentially, with the broader kind of context of increased cost of credit, the margin of error is significantly reduced. Yeah, maybe.
And it's worth saying, and the context here, I mean, again, we know we're speaking to CIOs, CISOs, IT teams, particularly risk and compliance here. So, why are we talking about debt covenants? Well, again, this is about building a business case for cybersecurity internally, and talking the language, in this case, of the CFO. So, where if you go to any finance professional or any CFO, debt covenants and the prospect of breaching covenants is the most terrifying. It's the thing that keeps them up at night, right? And any event that can trigger, a cash issue and therefore a potential going through a debt covenant is the number one concern, really. I mean, for that CFO. So if you can express cyber's risks in the context of debt covenants, cash flow, that's incredibly powerful internally, because you can just say, look, a cyber incident is a cash incident and therefore a credit problem. And that's fantastic. And that is such a good starter to a conversation when trying to secure budget for cybersecurity, when trying to justify a cybersecurity program, when talking to non-cyber professionals.
Yes, thank you. And it's worth saying again that this is covered within our white paper that I would encourage all of you to kind of head over to our website and kind of download. QR code coming up shortly. So 2025, I'll trot through this fairly quickly because we're 24 minutes past by my watch. But essentially just kind of pulled out some incidents, that some of which you would have heard about, some of which you may not have heard about, but in some way, shape or form, I think there are lessons for PE within all of these kind of incidents. So PowerStore breach, this is a technology provider for schools, occurred back end of 2024, kind of continued into January 2025. And they are, I mentioned earlier about the long tail of cyber incident. 2 years of credit monitoring is now being kind of put in place by this organization. The Bybit side of things, this was crypto platform. So crypto trading technology platform where technology is the bread and butter of an organization, but still kind of fell subject to an incident. Then we had the UK retail wave. The bit that is potentially of most interest to this particular audience is the bit on the right hand side there, the Korean leak campaign. Actually, we call this out in particular on this slide, where it highlights the fact that private equity as an industry, private credit, is targeted. It's targeted by individual groups who are very good at what they do. So shared provider was breached, admin visibility was gained, sensitive data was exfiltrated. This was a systematic campaign that we saw at the back end of 2025, targeting the industry in South Korea. So, yeah, just a bit of an eye opener, an opportunity to learn, I guess, for organizations that weren't impacted, but ultimately kind of could be targeted because they are attractive, and they are an attractive target. Bodhi, anything to add on that one?
No. I think for the sake of time, let's skip on.
Wonderful. So I think we probably touched upon this in kind of different ways, but AI acceleration, absolutely, we've kind of seen, and we expect to kind of continue to see that. Regulatory reach, I mean, the challenges that we see in kind of geopolitics regulation, it's impossible to kind of separate the two. New sector exposure, we in our kind of report and the white paper, we highlight the fact that there are these opportunities for growth that certain funds are looking to go after, whether it's defence, and that comes with kind of heightened kind of exposure. And then, of course, you've got, yes, we're kind of in the middle of the kind of the AI kind of hype curve. The quantum's not too far away, and the more, I guess, the closer we get to kind of Q day, as it's referred to, the more important that kind of quantum preparedness and an understanding of what quantum will bring from a computing and risk perspective will come into play.
On that one, I took a quote down from a portfolio CISO the other day saying getting kind of cryptography sorted in the portfolio is priority of theirs this year.
Yeah, absolutely. We're not sure when Q day is coming, but we are fairly confident that it's coming. Yeah, absolutely. So, Brody, would you like to cover this one?
Yeah, sure. So, I mean, what we try and do, as with any paper, is come to some recommendations by the end. So, a few of these are, putting cyber into the investment committee papers and valuation cases. So we're absolutely, obviously, we're seeing AI taking up more time in ICs, but actually cybersecurity, to a lesser extent, is also creeping in. And I think we sometimes speak to operating partners who are delighted when they get 5 minutes in it. But getting it into the papers and getting it into the valuation cases for businesses is really important. And actually, because we work with kind of smaller PE firms and as well as middle market and larger ones, we see the whole life cycle. So, we have worked with middle market PE firms on acquisitions, on the side due diligence, where we help them to argue down the valuation of business based on cyber issues, and where we found, dark web findings in the last week of a transaction, which has delayed it. And on the flip side, we work with those earlier stage PE funds or smaller PE funds to anticipate that and to getting down to 0.5, looking at exit readiness evidence early and trying to make sure that they're ready to anticipate any questions they're going to get. And at the same time, because we work with the LPs on their ODD across the whole private markets industry, we've got a really good idea of not only what is being asked in ODD at the moment, but what's coming down the tracks and what's growing as a priority. And then in some cases, we've got a say in what happens there. So that's really important. Focusing on a couple of the middle ones as well. I think mapping third-party concentration risk in the portfolio, particularly, that's something we have helped firms with. It's quite easily done. It's a questionnaire for the portfolio. Who's your hosting provider? Who are your MSPs? Going down to who's your HR software provider. It's an industry built on so much outsourcing that just looking at the risk of an organization at an enterprise level is inadequate, and actually mapping third-party dependencies is crucially important. And obviously there's a regulatory context of DORA, which is making that a requirement in some cases, but it's just good practice, just understanding, how much of your portfolio is reliant on, I say, Microsoft. It might be that there's nothing you can do about it, but it's good to know that if there's a problem, if there's downtime, you can anticipate the fallout in terms of your portfolio. Bunch of other recommendations in that, but please download the paper to find out.
Yeah, I think DORA is a really interesting one. So even for organizations that may not be kind of directly impacted by DORA are looking at it as kind of best practice, as good practice, best practice, and are implementing some of the stuff that's outlined in that piece of regulation. So yes, absolutely relevant. So I don't know. I think we probably could have covered a lot of this kind of throughout the course of the presentation. So we won't kind of linger too long on this one. But essentially, with as kind of Rolly said, the link between kind of cyber and cash and kind of EBITDA is absolutely kind of is absolutely made. It's something that is kind of undeniable. The focus on kind of preserving exit multiples is kind of central to most kind of operating partners and anybody within PE, absolutely. And then the support from LPs and ESG.
Yeah, totally. And again, we focus so much on the broader context of cybersecurity from a value perspective, from a private equity industry perspective. And that's not to the detriment of getting into the weeds and actually and providing the technical solutions, providing the risk solutions. It is just because we have identified one of the biggest problems is the information disconnect or the knowledge disconnect between the cyber subject matter experts, to the extent that there are any in a firm, and the decision makers and the budget owners. And so what we really have tried to position in this paper is cybersecurity as a valuation lever. It's a value creation, but also a value protection exercise. We are sort of banging on about this ad nauseam because we have so often worked with our client within the firm to position the justification for cybersecurity, which in this day and age you might think, given your roles, shouldn't need to happen, but it really does. Everything needs to, in a really lean business, everything needs to be framed in the context of value protection and even better value creation.
Yeah, absolutely. I think the best way of doing that is doing exactly what we've got lined out and kind of on this slide, which is a series of activities that take place during the life cycle of the investment. It's not one and done. It's not something that occurs once a year even. It's something that has to take place kind of over that life cycle. Again, all outlined in our white paper. Speaking of which, let's get to the key takeaways, and we can flash up the QR code for the white paper. So yeah, both conscious of time, but essentially it's a challenging market to operate. Yes, it's optimistic, but cybersecurity is now kind of baked into the rules of the game. The link between cyber and the debt servicing capacity is now kind of understood, and it is something that I think cybersecurity professionals, particularly in PE, should become more comfortable with articulating. Yeah, I think that's just something that individuals in this space will need to kind of brush up on and as I said, become competent at understanding and articulating. And then, of course, those firms that do kind of place cybersecurity as central to their kind of operational excellence will ultimately be successful.
Yeah. I mean, just before we get on to the questions, and I know there are a couple. You mentioned the kind of investment life cycle. I mean, yes, there's look. We're always happy to have a chat. Ed and I, we have probably loads of recommendations off the top of our heads that we've seen add a huge amount of value in very similar firms to most of yours. So I won't get into them now, but in terms of that investment life cycle, is everything from that cyber is one of the streams in one of the streams in M&A due diligence, going through to kind of continuous monitoring of portfolio companies, doing kind of baselining. I see one of the questions, are PE firms standardizing cybersecurity controls across portfolio companies? Yeah, absolutely. So I think one of the most common moments in time in which a private equity firm engages with us is when they're raising a new fund, whether it's their first fund or a continuation. That is very often, or at the moment, that seems to be a very common time when someone within the firm decides, brilliant, we're raising a new fund, we're buying these new platforms, buying these new companies. This is the moment to embed cybersecurity into this new fund, into our portfolio. And so I think probably far more often than not, that starts with a kind of framework-based gap assessment. Like NIST, CSF is probably the most common one. Ed, you're the expert on that. And that is the kind of number one activity to identify the gaps in the portfolio and baseline security across it. I mean, that's fair to say, isn't it?
Yeah, absolutely. As you said, the minimum requirement or the expectations for portfolio companies to have these, have appropriate security controls in place, and having that kind of minimum baseline that's seen as the starting point rather than the finishing of line for organizations. As you said, a lot of organizations are doing this at the kind of the inception of new funds, and that makes perfect sense. But a lot of kind of PE will be engaging with portcos on an ad hoc basis anyway, just by virtue of the nature of the business. So increasing those kind of touch points and formalizing the touch points that they have with regards to cybersecurity, and providing additional insights, whether it's kind of the dark web monitoring, whether it's attack surface exposure, whether it's going a little bit further with the questionnaires that might be issued. All of this is kind of good. It's absolutely kind of what we're seeing and supporting on.
Okay, so then look, we're going to wrap up in the next couple of minutes. We've got one more question here. Are we seeing resistance from portfolio companies? I mean, I'll have a first stab at that. Yeah, there's always going to be some resistance. And it's a really common question we get asked by people implementing programs on the portfolio side is, what is the uptake going to be? I suppose to some extent, it's, am I going to get left high and dry, kind of rolling out a program with limited uptake? It completely depends on the dynamics of the individual fund and the relationship with the portfolio companies that exist. I mean, sometimes you're in a brilliant position where there are very well-established relationships. At other times, there's been a much more hands-off culture, and that's absolutely fine. You can work with that. I would say once a program is rolled out, and crucially, something like a CTO forum's been established, so the critical stakeholder in each portfolio company's been identified, brought into the fold, and brought into a community, you start to just demolish those objections so quickly. And so I'd say there's usually about an 80% uptake on kind of collective services that are bought for the portfolio. You're always going to have firms who decide that this replicates some of the tooling or some of the work that they've done internally. Absolutely fine, delighted, and you can just use those same tools to scrutinize them and just make sure that is the case. But what we get told really often is that being a CTO is such a lonely job, particularly in this context of a recently acquired firm, and they love being brought into a community with their peers, whether it's in the same industry or not. And having the opportunity, at the very least, to access one another, let alone access sort of shared knowledge, shared services. So yeah, I'd say yes, you're always going to have some resistance. No, it's not insurmountable.
Yeah, I think you hit the nail on the head. There's a that I guess is from our perspective is kind of worth focusing on, is almost having that community validate the good work that organizations do, and individuals in particular would do. So yeah, it is kind of blown at the top. Technology is an organization, is an industry that is rife with kind of burnout and loss of kind of good individuals, good people to I don't know whether it's kind of mental health or just kind of general kind of burnout. So yeah, making sure that there is a community safety net in place is something that the stakeholders within portfolio companies really appreciate. There's no downside to it.
Yeah, and then we've got one last question in the private credit area, which we talked about a bit. Should funds view cybersecurity as a liquidity risk? Yeah, I think we'd say yes, and actually that's what a whole section of this paper is about. So do go and have a look at that. It is undeniably a liquidity risk if you look at some of the really well-known retail attacks in the UK last year. Whether or not you're insured, that is the case. And from your perspective, obviously liquidity is not at the forefront of your mind day in, day out, but it's a really good argument. It's a really good way to frame what you do and the value you create and the value you protect.
Wonderful. Okie dokie. Bodhi, I can't see if there are any other questions, but
No, that's us done. So I think we'll give you all back 20 minutes and say thank you very much. Please do download the paper and please do get in touch, book in a call with Ed, and we'd be delighted to talk training.